In February 2016, a group of cybercriminals attempted one of the most audacious digital heists in history, targeting the Central Bank of Bangladesh and its foreign reserves. The attack was carried out without physical weapons or conventional disguises. Instead, the thieves used malicious code, phishing emails, and a deep understanding of global financial systems to nearly siphon off $1 billion from the Bangladesh bank's account at the Federal Reserve Bank of New York. Although the criminals managed to get away with $81 million, the implications of the heist were staggering. This was not just a tale of stolen money but a stark reminder of the vulnerabilities in an increasingly interconnected world. The event revealed weaknesses in cybersecurity, regulatory loopholes, and the ever-present threat of state-sponsored cybercrime. At the center of this digital drama was the SWIFT financial messaging system, a network used by over 11,000 financial institutions globally. By compromising this system, the attackers temporarily seized control of the bank's international transfer capabilities, exposing the fragility of even the most trusted infrastructure. But how did it all happen? The story begins with vulnerabilities, a series of gaps in systems, oversight, and vigilance that the hackers exploited with chilling precision. Part 1, Setting the Stage. Bangladesh Bank, a vulnerable institution. The Bangladesh Bank is the central financial authority of one of the world's fastest-growing developing economies. As the custodian of the nation's foreign exchange reserves, it maintained accounts in various global financial institutions, most notably the Federal Reserve Bank of New York, where billions of dollars were held to support international trade and economic stability. However, like many developing institutions, the Bangladesh Bank lagged in cybersecurity. It relied on outdated systems, lacked essential protective measures like firewalls, and had insufficient monitoring for unauthorized access. Internal audits had previously flagged vulnerabilities, but resources and technical expertise to address them were limited. The attackers were aware of these gaps. Their plan required months of preparation, during which they would infiltrate the bank's systems, study its operations, and wait for the perfect moment to strike. The SWIFT network, the golden gateway at the heart of the heist, was the Society for Worldwide Interbank Financial Telecommunication, SWIFT, the global financial messaging system used for secure cross-border payments. Trusted by banks worldwide, SWIFT processes trillions of dollars in transactions daily. A breach in its system could enable attackers to transfer funds with an illusion of legitimacy. While SWIFT itself was secure, individual banks were responsible for protecting their local systems. This decentralization created a weak link. If hackers could access one institution's SWIFT terminal, they could issue fraudulent instructions that appeared genuine. Bangladesh Bank's outdated and poorly secured infrastructure made it an ideal target. The Lazarus Group connection evidence would later reveal that the attack bore the hallmarks of the Lazarus Group, a state-sponsored hacking organization linked to North Korea. Known for their involvement in high-profile cyber attacks like the Sony Pictures hack and the WannaCry ransomware incident, the Lazarus Group specialized in financial crimes to fund the isolated regime's cash-strapped economy. In this case, the Lazarus Group's involvement was not only practical, stealing millions of dollars, but symbolic. By targeting a central bank, they demonstrated their ability to infiltrate even the most secure financial institutions, challenging global perceptions of cybersecurity. Part 2, The Heist unfolds. The cyber infiltration. The first phase of the heist involved penetrating Bangladesh Bank's network. Using phishing emails, the hackers targeted employees with convincing messages that contained malware. When unsuspecting staff clicked on these emails, the malware infiltrated the bank's systems, granting the attackers access to critical infrastructure. Over several months, the hackers 1. Monitored internal communications to understand how SWIFT transfers were processed. 2. Stole credentials to log into the SWIFT terminal. 3. Tested their access with minor, inconspicuous actions to ensure they remained undetected. By February 2016, they were ready to strike. The heist begins on Thursday, February 4, 2016. The attackers initiated 35 fraudulent SWIFT transfer requests, attempting to steal a total of $951 million. The funds were to be transferred from the Federal Reserve Bank of New York to accounts in the Philippines and Sri Lanka. The transfer details: Philippines accounts. 1. The majority of the funds were directed to Rizal Commercial Banking Corporation, RCBC, accounts. 2. These accounts, opened under false identities, served as the primary laundering hub. Sri Lanka account. 1. $120 million transfer was directed to a Sri Lankan charity. The hackers' goal was to move the money quickly into jurisdictions with weak anti-money laundering controls, particularly the Philippines, where casinos provided an ideal laundering channel. A typo saves the day. Despite their meticulous planning, the attackers made a crucial error. In the transfer request to Sri Lanka, they misspelled the word foundation as fandation. This typographical mistake raised suspicion at Deutsche Bank, an intermediary processing the transfer. The bank flagged the request and contacted Bangladesh Bank for verification. This inquiry, coupled with the unusual size and volume of the transfers, prompted a closer look at all 35 transactions. As a result, some of the fraudulent transfers were blocked before they could be completed. The stolen $81 million, although most of the $951 million was stopped, $81 million successfully made its way into the Philippine banking system. From there, it was 1. Converted into Philippine pesos. 2. Funneled through casinos and junket operators. 3. Disguised as gambling proceeds and cashed out. The unregulated nature of the Philippine casino industry made tracing the funds almost impossible. Investigators later estimated that only a fraction of the stolen money could be recovered. Part 3: Discovery and immediate aftermath. The shock at Bangladesh Bank. When Bangladesh Bank employees returned to work on Monday, February 8, they found a series of error messages on their SWIFT terminal. Initially, they suspected a technical glitch, but inquiries from the Federal Reserve and Deutsche Bank revealed the horrifying truth: their systems had been compromised, and hundreds of millions of dollars were at risk. The realization triggered a frantic effort to trace the transfers, freeze accounts, and recover the funds. However, delays caused by the holiday weekend allowed the hackers to stay one step ahead. Global fallout. News of the heist spread quickly, sparking outrage and concern across the global financial community. The Federal Reserve faced criticism for processing the suspicious transactions, while SWIFT came under fire for not detecting the breach sooner. Bangladesh Bank filed lawsuits and launched a massive investigation, but the damage to its reputation was already done. The incident exposed the bank's vulnerabilities and highlighted the need for better cybersecurity in the developing world.